Glad to have you with us here. This is a special edition of the Retirement Education Hour. Hi, everyone. I'm Megan Mozak, and right now I'm in the studio with Kirk Cassidy and Michael Masserant. They're both financial instructors here with the Retirement Education Foundation. You know, the foundation brings you this show each and every week. They also bring you an opportunity to go deep into these topics with courses held at major colleges and universities near you. We'll be telling you about that today. But I did say it's a special edition of the program, and that's because I guess you could call it a twofer, right? A 2-for-1. You're going to get Michael Masserant with Kirk here as we kick things off, talking about the big Fed rate cut. Later in our program, we'll be joined by Dr. Paul Metler. Of course, he is a psychologist. He's also a financial advisor. We're going to talk about what this Fed rate cut might do to your psyche, your mindset as you're thinking about retirement. But before we get to that, of course, we're going to dive into all of the details about this cut, why it happened, why rates change, and how it can impact your retirement future. Kirk, Michael, I want to kick things off. The phone number, if people have questions, 800-240-8981, or go to retirementplanningedu.org. This, we knew this was probably coming, and it has arrived. Where do we go from here?
Well, that's why we have Michael here. Michael Masserant is our financial analyst for the charity. And we're going to bring in Dr. Paul Metler to talk about some of the emotional impacts, and people say emotional impacts, but the behavioral impacts of the Fed's decisions, and more importantly, with the media and the financial service industry sort of uses to manipulate and drive fear and anxiety into people so that they make often poor decisions around their money. So I want to start, Michael, today talking about what the Fed has done, why they've done it, what's really driving it, and why are we seeing this cut? And why is there likely to be some more?
Sure. So let's start with what is the Fed's job in the first place? The Fed has two mandates. Their first mandate is to maintain stable prices, which is to keep tabs on inflation. Their second mandate is to maintain a strong labor market. So all they look at all day long are inflation data and jobs data. And what they're trying to do is they're trying to use the interest rates to make sure the economy does not overheat or to make sure the economy doesn't get too soft. And what we've been seeing recently is inflation has been falling. We've had a strong labor market until, again, recently. And so the Fed has had interest rates relatively high for the past couple of years here. Now that they've seen inflation cooling off, but the job market starting to weaken, they're starting to cut interest rates. They use interest rates kind of like gas and the brakes for the economy. When interest rates are high, that is like brakes for the economy. Higher interest rates cools the economy off because it slows down companies from investing. Lower interest rates makes money cheaper, makes people more willing to invest more money, take on more debt. That will speed the economy up a little bit. So we've been seeing the labor market weakening. That typically signals employers, companies getting a little more nervous. So the Fed wants to start cutting interest rates to reassure these companies, look, if you need to borrow some money to hire more people again, you can do so. So now that we've seen this weakening labor market, the Fed is cutting interest rates a little bit, and they've signaled that they're going to continue cutting interest rates in the near future to make sure that we don't get a labor market that gets too soft.
So that was great, Michael. So the point of today's show is going to be talking about how interest rates impact everyday Americans' lives, particularly those approaching or in retirement. So we're going to go through a number of different things that are common when we see interest rates being risen or cut. And we're also going to talk a little bit about what I see, Michael, and we're going to go to break here in a minute, but we can come back from break and talk about this a little bit. But what this suggests to me, and I think many people in our industry, that they look at, and I know I might be taking a leap, but it seems like they're more fearful of the labor market than they are of inflation, almost signaling that the inflation, the tariffs are a temporary inflation blip, and they're less concerned about that and more concerned about a softening labor market. So we're going to jump in today. Stick around. We're going to go and talk. We're going to share with you all the ways it impacts you. It's similar to what we do in our 8-hour, almost master's level retirement courses that we teach. The charity teaches. You know, we've taught over 10,000 people, actually tens of thousands of people now, at major universities and colleges in the area. And all we ask you to do is make a $29 donation to charity to attend this 8-hour, almost master levels course. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
So you mentioned because the Fed has two mandates, they sort of have to bounce back and forth between what's the primary focus, inflation or jobs. And this is something that gets, personal for people and everyone has a different opinion on it. But you're right. Right now, the Fed seems to be focusing more on the labor market and they seem to be saying, we're close enough to our 2% inflation target where we're not worried about lowering interest rates. We're not as of this time right now, worried about inflation popping back up. It seems like right now they're signaling they're more worried about making sure that the unemployment rate, the labor market, does not get any worse.
It's funny. I did that on purpose, Michael. I did, right? Because I mean, you just think about our listeners right now, and depending on what side of the aisle they're on, depending on what their biases are, everyone is going to take what the Fed does or doesn't do and take their own bias and spin it to that's what they are signaling or suggesting, which is super interesting, but I think is dangerous. The idea that we can be really objective about what we think the economy is going to do or why the Fed is signaling things or doing things or saying things. I mean, it's so amazing. I mean, like Fed watchers, this is all they do. They look at every word that's coming out of his mouth. They break down all of their speeches and look for different key signals to suggest a cut or a raise to interest rates or we're going to keep interest rates, suggesting because there are market impacts. There are economic market impacts to whether they're cutting, whether they're raising, whether they're what they're doing. And so they're looking for that edge, which is super interesting. I think people are nuts. I think people should just buy the index, and everyone with all their angles are trying to hedge here. No one beats the index over an extended period of time, Michael. It's crazy.
Well, and that's why people, to your point, can get really wrapped up in this, and people they'll see what they want to see, they'll hear what they want to hear. So some people are hearing, well, the Fed's cutting rates because the job market's too soft, and the fact that the job market is soft is bad for the stock market. Other people are hearing the Fed's cutting rates because they think they've won the war on inflation. It's the exact same outcome. Rates are going down, but people can interpret that data to fit their own narrative about the stock markets being up or down. And this is why Paul's coming on later to talk about the psychology of this. It can really mess people up.
It can. The reality is in retirement, and this is something we spend a lot of time talking about in the class. Any sort of short-term market economic events should not drive any decisions you're making around your investing, your spending, your retirement dates, your vacations. There is not a short-term market event that should drive any of those decisions. And this is why our charity hosts this 8-hour, almost master level course at major universities and colleges to help you prepare to know what specific information you should be looking for to find the right teams to help you. So if you'd like to attend one of our courses, go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll return with Kirk and Michael right after this. And we're back. Happy to be here. We're in the studio again with financial instructors Kirk Cassidy and Michael Masserant. And we're glad you're with us as well. We're talking about this rate cut. You might have read the news, 0.25% rate cut by the Fed. And we had some idea that this was coming, but it is official. And today we've got Michael Masserant here alongside Kirk Cassidy, and we're talking about this from a financial perspective. Later in the show, you'll hear from Dr. Paul Metler, who is the psychologist here at the foundation, to talk about how this could affect behaviors. If you're thinking about retirement, newly retired, you want to retire one day, well, this is a show for you. We're really kind of looking at both sides of the coin, the practical and then, of course, the behavioral. So as we get back into this, I want to make sure people have the information, Kirk and Michael's. So I'm going to give that here quickly. Retirementplanningedu.org. You've been hearing us talk about the courses. These are like master's level courses on retirement planning. And with all of the ups and downs and the impacts and the changes from the market to Washington, D.C., and we're even talking about that today, there are a lot of impacts to your retirement. You need to get educated, and the foundation makes that its mission, and that's why these courses are so critical. We want to see you there. Here's how you register. Go to retirementplanningedu.org. That's retirementplanningedu.org. These courses are held at the University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, the University of Missouri, and Columbia College. You can also call to register 800-240-8981. Okay, let's talk now about why the Fed did this, Kirk and Michael, and what does it mean for us?
Well, Megan, the Fed cut 0.25%. I think signaling another quarter to come, maybe a half, we'll see. It'll be interesting depending on what the employment number comes back at and inflation numbers come at, which we will have before the next meeting. So, what we should focus on this segment, Michael, is explaining what that means and how it directly can impact retirees. And then I'll dig into a little bit about some of the things you might see out there in the marketplace that you should be cautious about.
So for retirees and for anyone who's near retirement, what this means for a lot of those people is that the bonds in their portfolio. So as interest rates fall, bond prices go up.
I know it's confusing for people. As
So
soon as
this
you
is
said that, I
so
know.
as interest rates are falling, bond prices are going up. So many people right now are seeing the bonds in their portfolio go a little higher than they were a couple weeks ago, which that's great on the front end because everyone likes to see their portfolio go up. But one really important consideration, especially for seniors and savers, we called, as they were cutting interest rates and that they had low interest rates for a long, long time, we called that the war on seniors and savers. Because when interest rates were so low, savings accounts were paying nothing, money markets paid nothing, treasury bonds paid nothing. And so it's very hard for seniors and savers to have any reliable income from their portfolio. Over the past couple of years, treasury bonds are paying 4.5, upwards of almost
Yeah,
5%, depending on the
on the short
duration.
end of the curve, for sure.
And so it was really, really easy for those near retirees and people who are retired already to generate income from their portfolio. Well, now they're cutting interest rates. So it's great that the bond prices are going up temporarily, but now they're seeing reduced income from the bond portion of their portfolio. So it's going to be tricky to make sure that retirees have this all mapped out properly to know where is your income coming from. If you're retiring in the next 1, 2, 3, 4 years, where is your income coming from? If you're retired already, where is your income coming from to make sure that you're getting the income you need? Because when interest rates were 4.5, 5%, you could sit your money in a CD or in a money market and get 5% of your money. That's fantastic. That's not going to happen anymore.
Well, I think this is where a lot of people get in trouble. I could tell you this is where the financial service industry really leans in to try to fear and create doubt and uncertainty. Here's the thing. We have two things happening. While the Fed is cutting, we're also seeing the yield curve normalize. And I'm not going to get into too much detail of what that means than to say we have had an unusually high interest rate on the short end of the curve, meaning shorter maturities, meaning short-term CDs, corporates, treasury bonds, short term, less than 2 years and in, especially 2 years and in, we're paying ridiculously high interest rates that at the charity we had been screaming is not sustainable and you can't build a retirement plan based upon this. Ultimately, the short end, shorter term bonds, treasuries, CDs, and money markets aren't going to historically, over any extended period of time, pay a high interest rate. In fact, often I will say, and I want to be careful what I quote because I don't have the data in front of me. Michael will correct me because he has this stuff on the top of his head. He'll correct me in a hurry. But I would say struggles to keep up with inflation if we're just thinking about money markets and CDs. Is that fair?
CDs will often they'll tread water with
Tread
inflation.
water. Okay.
You won't get much further ahead than inflation. In the past couple of years, you were beating inflation, which
That's
is
the point.
great, but that's unusual. And for people who are relying on that recently, that's going to go away pretty soon here.
Well, my fear is I think a lot of people have leaned into that because it was so safe and comfortable, and I can have a CD or money market or just even buy really short-term treasuries, and that would be my income planning for retirement, and that's not sustainable over a 30-year retirement. That's not how you build a retirement plan. Now, the flip side of that coin is now careful because the insurance salespeople, which are all over these airwaves, I mean, I won't say all the companies, but everybody other than this charity right here that is on our local airways are primarily annuity salespeople. And with interest rates high, they were able to promote, Michael, ridiculous. They could take current interest rate and back test off of current interest rates, which is not sustainable, not typical, and interest rates and renewal rates on annuities update every single year and right now are falling. They are falling quickly. And again, that's the annuity trap. So the whole purpose of the charity, Michael, at its core is to provide people with understanding the right math to make the right decisions, understanding the right questions to determine if the people that are currently helping them or people they're currently interviewing to help them, are they really providing the solutions that they say they're providing, or are they just really good at sales and marketing and they say they're doing things that they're not really doing. And you $1 to $10 million people are the perfect people to target because you're a little overconfident. You've been successful in your careers. You've been successful in saving, and you have some wealth. And so you're a little overconfident, and you're way overconfident in your belief to be able to determine if someone's being truthful or not with you around money. But the fact is, you don't have the right information to be asking and looking for. And that is the purpose of the charity's 8-hour, almost master level courses that are taught at major universities and colleges in your area. And even if you're not in an area where it's being taught, we stream these classes live from the university. So wherever you're at in the country, listening to our podcasts or listening to our radio shows or watching our TV shows, you can participate in the class. All you have to do is make a $29 donation to charity. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll be back. There's plenty more Retirement Education Hour straight ahead. And we're glad you're with us. We're talking about the rate cut. The Fed cut the rate 0.25%. What does that mean for you? What does it mean for your retirement? And we've got the right people here in the studio to talk about this today. We're joined by Kirk Cassidy and Michael Masserant. Of course, they're both with the Retirement Education Foundation. They're financial instructors there. Michael is a financial analyst, so we're picking his brain. And then later, we're going to talk about what this means behaviorally. We've got Dr. Paul Metler joining us on the second part of this program to talk about what it could mean for investors, retirees, for you. And so stick around for that as well. I do want to give the phone number and the website to our listeners today. If you've not been to the courses that the Retirement Education Foundation holds at major colleges and universities, you owe it to yourself to do so. If you want to retire, if you're retired, this is a course for you. There's so much at stake right now, and we want to see you there. These courses are like master's level courses. Appropriately, they're held at major colleges and universities right near you. You can find the complete list and all of the sign-up details at the website retirementplanningedu.org. That's retirementplanningedu.org, or call 800-240-8981. That's 800-240-8981. Okay, when we look at rate cuts, historically, we go back in time, what has this traditionally done, Michael and Kirk, to the market, to stocks and bonds?
Well, I'm going to let Michael really dig into this. I'll throw a little color around it, and I'll let him give some more detail. Same thing, color detail. I just want to take a pause for a minute and remind our listeners. So the Retirement Education Foundation is a national charity. We have taught tens of thousands of people for over a decade. Retirement Education Foundation has a number of different programs. We also do teach financial literacy in lower income communities and rural communities for high school juniors and seniors, which is an incredible program. We have hundreds of thousands of people consuming the charity's content, whether it's webinars or white papers. Michael happens to be the financial analyst that produces a lot of content and data for that charity. So I wanted to bring him on to talk about the Fed cut means, and likely more cuts to come. And I know, Michael, and I can let you get into details, what we know when historically Fed movement, raises to interest rates or cuts to interest rates lead to volatility. And when interest rates when they're cutting interest rates, they're really pushing down the gas pedal, we see stocks often take off a little bit.
You're right.
Historically, I want to be careful. Past performance, blah, 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 blah.
No one's market timing here. And that really is, to that point, that is the importance. And I know you'll talk about the psychologist later with Paul, because Paul's the psychologist. Of course, he's better positioned to talk about the mental side of this. But people will, historically speaking, when the Fed is cutting rates, that has historically been a good thing for the stock market, because all these corporations are now being told by the Fed, if you need to borrow money, you can do so cheaper now than it was before. So now these corporations can go borrow money, they can hire more people, they can invest in more programs to try to drive more profits for their corporations.
Typically brings down mortgage interest rates, typically brings down any sort of financing, typically brings down the cost of borrowing.
Exactly. So that'll unlock things like home sales and car purchases. And now it's going to spur the U.S. consumer. Our economy is roughly 70% driven by the US consumer. So if the US consumer is spending, that means the economy is stronger. That means companies are doing better. That means the stock market will, on average, do better. So what the Fed is trying to do is spur the consumer, spur corporations to spend, borrow, spend, borrow. Now, on the flip side of this, people are going to say, well, wait a minute. The Fed said they're cutting rates because the labor market is weakening. And so if the labor market weakens, that means the US consumer will be less healthy. That means they're going to spend less. And that means we might have a bad stock market. Both those things could be true. And this is why it is so important for people to have a plan and not try to let their emotions dictate things. Because historically speaking, yes, as the Fed is cutting when we're near all-time highs in the stock markets, typically 12 months later, the stock market is higher. That is an average. That is true. Typically.
Yes.
But that is in no way a guarantee that this time that'll be the same case. So,
again, Michael, this goes into the behavior. We'll get into this with Paul, but it depends on who's listening. They're going to be like, oh my gosh, they're cutting interest rates. Cutting interest rates can also tend to greater inflation, right? I mean, overstimulated economy. It's super fascinating what's going on here, and everyone's own biases is going to influence what the whys and what it means. And if you're allowing these things to drive your financial decisions, what you buy, what you sell, what you hold, what you spend, all of these decisions can never be determined by a short-term market event, Michael. That's just crazy.
Well, and this is also why when someone's investing their money, you cannot invest your money based on some rule of thumb, some 60-40 portfolio, or take your age minus 100. That's how much stocks you. Those rules of thumb are absolute garbage because those things do not take into account your timeframes, your goals for your retirement. If someone is 5+ years from retirement versus if someone's retired already, their portfolio, their investment should look very different. And this rate cut is another example of why. Because if they do cut rates and inflation does take back off, you need to have more stocks to keep up with inflation. If they cool the rates and they cool the economy, you need to have the bonds to protect you. So it should be based on your plan, not based on how you feel about the economy in the next 12 months.
Michael, it's really difficult to watch. Because here's the deal. It's not the listener's fault that these general rules of thumb don't work. And it's not the listener's fault that's what they have followed independent for so many years. It's the industry's fault. And one of the things that we really spend a lot of time talking about in the class is the why of these general rule of thumb. Why does the industry come up with these, we factually know, not the best rules of thumb for everybody? And everyone, see, everything should be goal-based. And that's, again, a theme in the class. What do I need to give me what I want? What do I need to give me what I want in retirement? And that will determine how much risk you should take. When are you spending the dollars? That will determine where you should invest those dollars. All of these things need to be quantified with math, the correct math that unfortunately most people don't know and most of our industry ignores, because the correct math is a lot of work. And that's what we teach in the class, Michael.
And for a lot of people, what's challenging is because they have been successful in their careers. They have been successful saving.
I know.
They think they have the handle on the correct math. And we've met at the class lots of people.
CFO for Fortune 500 companies.
Who are really sharp people who just they walked in thinking they knew and walked out realizing they did not know the correct math.
I will tell you, if you come to this class, your whole approach and perspective about retirement planning and what the math really is will change. We guarantee that. And I'm talking to that $1 to $10 million family who is a little bit overconfident right now about what is going to drive success in retirement. So do yourself a favor, attend one of our almost master level courses, 8 hours, 2 evenings, or 1 full Saturday, 8 hours. It is a lot of information. It goes fast. It's comprehensive. If you'd like to register, all we ask is for a $29 donation to charity. Go to retirementplanningedu.org. That's retirementplanningedu.org.
And stick around. Plenty more Retirement Education Hour is coming up next. And we're back. Glad you're aboard today. This is the Retirement Education Hour. Want to remind you that this show, you can listen as a podcast. In fact, all of our shows are designed that way. You're welcome to download it wherever you find your favorite podcast. Search for the name of our program, Retirement Education Hour. And today, we're focused on this 0.25% rate cut by the Fed And we've been hearing that perhaps something was coming and they did make it official. So today we've been talking about why the Fed does this, what the impact could be. And we now have Dr. Paul Metler joining Kirk. And of course, he's a psychologist and he's going to talk to us about some of the behavioral aspects of this rate cut, this impact. And specifically, we're going to talk about fear. And I'm going to get to that here in just a minute. But I do want to make sure you have the information so that you can sign up, get registered, and attend the Foundation's courses on retirement planning. This is where you can really get into the weeds with financial instructors just like Kirk and Paul and Michael. Get all of your questions answered and feel more empowered and confident about your retirement future. We want to see you there. It's like a master's level course. So you can really expect a massive download, and you can attend at major colleges and universities. That's where these courses are held, including the University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, also the University of Missouri and Columbia College. So reach out today. Go to the website. Sign up now. Retirementplanning.edu.org. That's retirementplanning.edu.org, or call 800-240-8981. Okay, I mentioned fear, Kirk and Paul, and this is something that the financial services industry likes to prey on us with, right? This is the wedge they use, and they really do kind of attack us this way. How so?
Well, it's interesting, Megan. Again, I'll take a step back a little bit about the charity, and I'm glad that Paul, Dr. Metler, was able to join us today. Paul, well, first, again, the Retirement Education Foundation is a national charity. We've taught tens of thousands of people with our 8-hour, almost master's level courses. Hundreds of thousands of people are consuming our podcasts, TV shows, our webinars, white papers. And to have a psychologist who's also in the financial service industry, but a psychologist who is actually fellowship trained in geriatric psychology for the charity is invaluable, contributes a ton to the content and what we teach in the class. And one of the challenges, Paul, frankly, and this is a great example, the Fed and what they do or don't do, really along the lines of what's going on in the economy, what fears can we stoke, drives a lot of decision making, particularly as people age and the relationship with money begins to shift. When they start to recognize, hey, I'm not quite as sharp as I used to be. I need to provide my own paychecks every month because someone else isn't sending, I'm not working for someone any longer. Those who haven't experienced this yet don't quite know what we're talking about, but those who have, I'm pretty confident know exactly what we're talking about. But with that shift in relationship with money, we tend to make more behavioral decisions. It's amazing. Executives, engineers, really, really, really sharp people who have made really good logical decisions their whole life enter this close to retirement, then retirement phase. And all of a sudden, the emotions and behaviors start driving a lot of their decisions. And it can be dangerous.
It can. It would be nice if intellect was a buffer against anxiety, right? It would be nice if the smarter you are, the less anxious you would be. Sadly, intelligence has nothing to do with how much anxiety you have. And, not to be a conspiracy theorist here, but I mean, if there was a population that struggles, with anxiety, it's going to be older people, just because it doesn't even matter if you struggled with anxiety all your life.
It doesn't matter.
Right? It doesn't matter. You get to a certain age and you're facing a lot of things that stoke anxiety, whether it's, who are you? I mean, we could spend a lot of time talking about it, but it's a population. We all struggle when we get older, and, it's a great population. If you want to push some buttons, the financial service industry has done a pretty good job of doing that. And the subject we're talking about today, they've really spent some time causing, triggering anxiety when there really shouldn't be.
It's interesting, Paul, because that cohort, those that are recently retired or retiring, with that $1 to $10 million family, who, and I keep bringing this up, this particular show, that $1 to $10 million family, they're really sharp, they're smart, they've made good financial decisions, they are often highly educated, and they're not always as aware of how their anxiety is driving their decision making. And literally, I don't know how to tell you guys, you $1 to $10 million families, this is literally the charity. It's all well, it's not true. We work with younger adults too, but we have taught tens of thousands of you, hundreds of thousands of you consuming our information. we can tell you, we know how you're going to react and respond and behave. And one of the challenges with that cohort, particularly right now, because there's so much divide around politics and emotions and our behavior and what we glean from the Fed cutting or raising or not cutting, or what they say about is the tariffs temporary inflation or long-term inflation. There's so much biases in this, and we all want to be right. So then we incorporate confirmation bias. You understand how easy it is for them to sell annuities when people are afraid, right? It's so easy to sell the concept of here's a dial of probability. You have an 85% chance of not outliving your money. Well, I don't know about you listeners. Most people we know aren't very comfortable with that. That isn't an accident, Paul, right? The less you spend, the more they make. The longer you work, the more they make. The more fear you have, the better it is for the financial service industry. You need to know that. Paul, what is the antidote to fear and anxiety?
Education
And medication.
Yeah. We can't give that.
No,
I'm sorry.
no.
We can't do that on the show. It's, knowledge obviously provides some power, right? The more information you have, at least, the better you are able to manage that anxiety.
And just to tee it up a little, Paul, so we're a charity
that's what we do.
Just promotes education
That's right.
around finances.
Right. Really to help address people's anxiety.
Yes.
Right.
Yes.
That's what it's about.
And so the thing is, Paul, and we say this constantly, is like, you $1 to $10 million families, I cannot imagine. We are a charity. We're here to educate you and prepare you to help you give you the tools to find the right teams as you age, because you're going to need teams. You're going to need it as you age. You $1 to $10 million families have different challenges. Financial elder abuse is 1 in 4 chance. Cognitively, you will decline. It's just how rapidly and when. You need to educate yourself so you know exactly what you should and shouldn't be looking for and what the right and wrong math is, and to help you remove some of the biases and fears. So attend one of our 8-hour, what is like a master's level course taught at major universities and colleges in your areas. And we stream these live wherever you're at in the country to be able to participate. All we ask is a $29 donation to charity. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll be back with more right here on the Retirement Education Hour. And we're glad you've tuned in today. This is the Retirement Education Hour, focus today on the big news from the Fed. There is a 0.25% rate cut. It is official to interest rates. And we're talking today about why that happened, what it means, and what it means for you as a retiree or soon to be retiree. There are some impacts, and we need to get out in front of those. Earlier, we were talking about fear, and that's really the tool, the wedge that the financial services industry uses to prey upon people. And we're going to continue talking about this theme of fear and what you can do about it. I first, though, I want to pause. I want to make sure that you have the ability to get registered and attend the Retirement Education Foundation's courses on retirement planning, and these are held at major colleges and universities in your community. And here's that list. There are a lot of locations, which makes it very convenient for you. The University of Michigan, Eastern Michigan University, Michigan State University, both campuses, Novi and Troy, Oakland University, the University of Missouri, and Columbia College. Your choice. Pick a date, pick a location, pick a time, and we will see you there. Get registered now. Seats do fill up really quickly, so go over to retirementplanningedu.org. That's retirementplanningedu.org, or call to register 800-240-8981. So we were talking about fear, and that is kind of the primary driver that we see so many in the financial services industry using, right? They want you afraid, but in the end, fear really does not solve anything. And the two of you say it's time to flip the coin on that. Fear should not be the driving force, and there's a way around that.
Well, there is a way around it. It's not easy, right, Paul? I mean, we've got Dr. Metler on to talk about this, and look, whatever side of the coin you flip, whether it's interest rates rising, interest rates falling, a Democrat in office, a Republican in office, it's always the end of the world on either side. It's all this anxiety and noise around us. And the truth is, Paul, what happens is when we're working and we are in control, we feel like we're more in control. We're working, we're getting a paycheck. Things around us don't really impact our day-to-day spending in terms of who's being elected, who's in office, because we got a job. And most of the people listening, those $1 to $10 million families, have a good job. And they're not as worried about, they worry, but it doesn't impact them the same way financially based around what's going around economically, politically, geopolitically around them. But once they approach retirement and realize, oh, I'm going to actually have to pay myself as I'm aging, as cognitively I am declining, and the studies and research all say the same thing. Mathematics is one of the first, if not the first, skill that begins to diminish some. It doesn't matter what's going on. You're going to be, unless you get control of this, it's going to be really hard to make good decisions, and you won't make decisions with all this fear. So I'm kind of rambling because I'm not the psychologist, Paul, but I watch it every day. It's hard for me to put my finger totally on it. You're professionally trained with this, especially in that age group, that aging population. A lot of interesting things going on at the same time.
Yeah, you use the word a few times, control.
Yes,
Right?
control,
That
right?
word control. And
Perceived.
perceived control. I mean, when you think about aging, right? When you forget finance, when you just think about aging, you think about control, right? Whether it's you slowly cognitively start declining, whether you start having friends pass away, whether sickness
Yeah.
or your identity. All of
Yes.
us, most of us spent our life working, right? Who we are, where we built our confidence, our ego came from our job. And then all of a sudden, one day, it's the light switches off, and all of a sudden, you're not working, you're not doing all the things that you've done. Who are you? What's your identity? Do you have purpose anymore? We go on and on and on. All of a sudden, we don't feel like we have control. And then you throw onto this that the financial piece of this, it's not, of course, control is a huge issue with aging population. And the only way to grab on, and it's not surprising that people prey on that
they
subject.
do.
They love the fact that you're afraid, and they push all those buttons to make you afraid, to get you to do what they want you to do. At the end of the day, as you said, the antidote is get some knowledge, become educated.
Earlier, the better.
Yeah, do not wait. Do not wait till you're retired. The earlier you get knowledge, the more control you're going to have.
Paul, I hear it all the time. Once I start having issues, I will figure this out. No,
It's
it's too late.
Too late.
It's too late. So super interesting, Paul, because this control thing, it's almost what we're saying is 8 hours of comprehensive, almost master level education will help you gain greater control in a world that around you as you age is nothing but you're losing control.
Exactly.
Literally.
That's right.
You're losing
That's right.
control. So to accomplish that, Paul, and we're going to talk about it in the next segment. What's the solution? We'll give you the antidote, the true solution to this, which is centered around education and then finding the right teams. And that's what the charity is designed to do, is to teach you how to find those teams, what questions to ask, how do they get paid, what specific things you should be looking for, what's the right math, how do you know if someone's selling something? We're going to get into it, kind of started already because I get excited about solutions. But Paul, look, people don't recognize in your 60s, the data tells us 10 is it 10 to 15%? Yeah, 10 to 15% will see measurable decline cognitively in your 60s. In your 70s, it's 35 to 40% of you will see measurable decline. Now, look, they want you to be afraid. They know. See, old people, we know this, we see this every day. Older people aren't cheap. That's a stereotype. I know that some of us in society think the older you are, the cheaper you are. And that is not true. They get scared. And the more scared you are, the less you're willing to spend. You're more afraid to spend. So, Paul, help me here. Fix this for me.
No, actually, if I could just say one thing that's really important, because you said you threw out some statistics. And the one thing people understand is it's not like you are aware of this decline, right? I mean, it's not like you're going to have insight. It's not like one day you're going to say, okay, I'm declining. Now I'm going to go get help. The problem is some of the areas that we decline, some of the areas of our cognition that we decline are areas in our brain that limit our ability to understand, to perceive this. So the decline happens, but you're not perceiving it. You don't even know it. People around you, but they're not going to say anything because they want to protect you and make you feel good. your spouse doesn't want to hurt your feelings,
Yes.
then it's too late. That's why it's too late.
And then 1 in 4 people are victims of financial elder abuse. Literally 1 in 4 people. That's what's reported.
Right.
We know it's more
a
now.
lot higher.
I know, because you see it all the time. All right. This is why you need to attend one of our 8-hour, almost master level courses from a national charity that's going to give you unbiased tools to be able to make good, solid decisions to regain that control so that you will spend and enjoy your retirement. All we ask you to do is make a $29 donation to charity. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll be back with Kirk and Paul right after this. This is the Retirement Education Hour. Glad you're with us today as we talk about the Fed rate cut. 0.25%. It is official. Today we've been talking about why it happened, and what it means for you, how to get out in front of that so that you can have a great retirement. That's really what this show is all about, and that's what the foundation is all about. The Retirement Education Foundation wants you to have a great retirement. It starts with education, and that's why they hold courses that are master's level, like courses on retirement planning, and they hold those right near you at major colleges and universities. We've been telling you about this throughout the show today. I want to make sure you have that website, so if you've been thinking about it, maybe you're on the fence, this is the time to take action. That website, retirementplanningedu.org. Again, retirementplanningedu.org. That's the way to register. You'll see all the locations there, including the University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, the University of Missouri, and Columbia College. You'll also see all the dates and the times. Pick one that works for you, and we will see you there. You can also call, if you'd rather, to register 800-240-8981. And keep in mind, the show today, you can download it. You can listen to it as a podcast, share it with a friend, with a spouse, with a neighbor. We can go back into our library and revisit many of our old episodes there. Find a topic that you want to learn more about and enjoy. Just search for the name of our show, Retirement Education Hour. All right, we're back to this rate cut, and we've been talking about fear. We've been talking about why this happened, what it does to potentially our economy, potentially our retirements. And I want to talk about something we really focus on a lot here, and that's planning. How do you plan for your retirement when you never know what the Fed's going to do?
Megan, we said this like 6 times. It's just to flip the coin. Which side of the coin? And I'm going to say something that will hopefully offend everybody, so no one gets too mad at me. On
Or everyone gets mad at you.
Well, we're equally mad at in this comment. It doesn't really matter who's in control of our in DC. It doesn't really matter who's in control. Like, here's the thing: no matter who's in control, the other side's going to flip out. Both sides. It always happens this way. They're always going to, so there's always going to be all this noise constantly going on. No matter who's the end of this economy, the end of freedom, end of this, end of that, the whole thing. Big government, small government, too much debt, not enough debt. All this noise, and they don't want to. Do you really think they want to fix it, Paul? No. What? Paul started to lean forward.
You really want me to get into this?
We could do a show on this. They don't want to fix. That's how they raise money. They raise money based upon the anger and the fear people have. So it's not going to go away. Don't think that this is. Depending on what side you're on, this is a temporary event. Everything is temporary. And you're going to have many different major economic events throughout your retirement. You're going to have several different people in control of the government through your retirement. You can't allow any short-term events to drive any of your spending patterns ever. That is nonsense. That's crazy. In fact, that is exactly what the financial service industry wants, because the less you spend, the more they make. And they have no motivation, the financial day being the financial service industry, to make you feel better. In fact, I just heard a radio show the other day, Paul, on one of the airways locally, talking about that something's going to happen to your Social Security. They're going to take it away, or it's going to be cut. And what do you think that person sells? 80% of everything they sell is annuities. They're trying to sell you an annuity to replace your Social Security. They sell fear. That sells products and solutions. It's crazy. So here's the deal. The antidote to all of this starts with proper education, and then the more difficult part, a real comprehensive retirement plan, which none of you have. I can I mean, I've been challenging you guys for over a decade to come to our class, show me a plan. And I can tell you, none of you have a real comprehensive retirement plan. So the goal of the charity literally is to teach you what a comprehensive plan looks like, then what specific questions to ask based upon different scenarios to determine is the teams you're trying to hire actually doing that. And then we're going to give you the tools to do background checks. How do they get paid? Really to teach you how to find the right teams to help you and not let them take advantage of you so you can have freedom, less fear. You'll spend your money.
Yeah, you know, we've been saying over and over that the antidote is education, and it is. But the real antidote is planning. And someone wrote a note here, and I just love it. And you didn't say it, so I'm going to say it. Without a plan, right, changes seem like a crisis. And
Nice.
I think that's perfect. And I think that's true in life. I mean, I hate to, not to make it big, but it really is true. If you think of anything in your life that was really important to you, really important, without planning, right, it feels like a crisis. It feels huge. But once you plan, you sit down and you methodically think about step by step by step by step. Those steps are what give you control, gives you the structure. Structure helps reduce anxiety. That's how we reduce anxiety. A plan will reduce any anxiety you have, and things won't feel like a crisis. There'll be hiccups. There'll be, as you say, there'll be recessions in your life. There'll be market corrections in your life, but nothing will feel like a crisis because you've thought about it. You've already anticipated it. It's when you don't plan, you don't anticipate, you don't create that structure. Every change, every hiccup feels huge in a crisis, and then you react. You know, the key is be proactive. Don't be reactive. That's the best way to deal with anxiety.
I love it, Paul. And unfortunately, a lot of our listeners think they have a plan because they went to somebody else that's on the radio. They said the next 10 caller gets a free roadmap to retirement or some kind of guide to those guys those aren't a plan. And you need to come to a class or go to the charity's website and look at what a sample retirement plan should include and look like. The reason this course, it's like a master's level course and it's 8 hours, is there's a lot of information to teach you to make sure you find the team that is actually able to execute the right math with the right plan so we can reduce that anxiety so you'll feel freer to spend. If you find that right plan, you're going to spend 6, 7, 8% per year instead of the 4% that 3-4% that they want you to, because the less you spend, the more they make. So attend one of the 8-hour classes. All we ask is a $29 donation. These classes are taught at major universities and colleges in your area and streamed live for wherever you're at in the country. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
Retirement Education Foundation is a fiscally sponsored program of United Charitable, a registered 501c3 public charity. Investing involves risk, including the potential loss of principal. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Retirement Education Foundation is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Retirement Education Foundation is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Retirement Education Foundation. This radio show is paid for by the Retirement Education Foundation, a charitable program.